Hey everyone, you've made it to week 3, financial market analysis. We as market participants are nowhere without proper analysis, right? And we want to move from the sort of ignorant, unknowing speculator or spectator and somebody who invests just something because somebody else is doing it or there's a hype going on, etc. We want to stay away from that and we want to become knowledgeable and skillful investors and traders, whichever your direction is going to be. So this chapter is crucial for that. And this week, first of all, we do fundamental analysis. I'll explain what that is in a second. And next week is about technical analysis. And the two go hand in hand. And somewhere in between there, this week actually in the end is also sentiment analysis. And we'll keep coming back to sentiment analysis as well. So fundamental, technical, and sentiment are three types of analysis that we can use in order to determine something's value or what the perceived value of an asset is. And that is crucial to making solid investment and also trading decisions, I might say. So let's go to the slides again. Yes, this is where we are, but that is quite obvious by now. I'm keeping the structure. This week, as I said, is about determining the value of a company or a stock. Let's first just focus on that, because that, again, with a lot of the topics that we cover, it is in and of itself an entire study. But we do need to, of course, highlight this and give you the basics of at least how this works so that you can be on your way from there. So we're going to try to determine, is something over, fairly, or undervalued? And based on that, we can, of course, tweak our decision making. So is a business healthy, and is it thus a good investment? That's one of the key questions for this chapter this week, and just in your general journeys. And of course, there are ways to measure this, and we do this via our analysis. We have several tools, we have data to work with. And via this data, we can measure if a company potentially is a good investment. So how healthy is a company actually? Now, fundamental analysis, we can generally split it into two forms, if you will, quantitative and qualitative. By the way, that GIF over there is from The Big Short. I will drop a couple of movie recommendations, but The Big Short, I think I've only watched it maybe 6, 7, 8 times. It's really one of my favorite. It explains very much about the 2007 and 8 financial crisis, how that came to be. Great cast, lots of humor, just fantastic film in my opinion. So watch that. It's actually very enlightening as well when it comes to understanding what caused the crisis. Of course, in a Hollywood format, but a lot of fun. So definitely a recommendation. Quantitative is everything in relation to numbers. You can see this. I've copied this from Investopedia. Everything related to numbers is quantitative. So don't be scared by that number or by that word. Sorry, there we go. Confusion. Everything related to numbers, figures, ratios, and formulas. That's quantitative analysis. So we look at those type of things in order to come to a valuation for a company. And I'll get to blockchain and cryptocurrencies at a later stage. Let's focus on this for now. Qualitative, rather than a quantity of something, is the quality, standard, or nature. So by this you can think of the team members, for example, of a business, or the strategy that is applied, the vision that is there, that sort of stuff. Not necessarily as measurable as hard numbers, but very, very important nonetheless. And of course, when we get to early investing, the earlier a company is, the closer it is to this idea stage, the less quantitative information you're going to have, right? This comes later as there is some performance. Then we can start to measure in a quantitative way. But we start with a qualitative way, in my humble opinion, and that's where we look at okay, who actually came up with this idea for this business, and what is their plan for the future? What are they going to do? How are they going to raise money? Are they able to raise money, etc.? Those things are more along the qualitative lines. One of the first metrics that you will find, and you will find what I'm talking about in the sources as well, I just want to highlight it briefly, and in the lecture I will go over this a bit more in depth. But one of the key metrics for determining the value of a company, when we say this company is worth so and so much, is market cap. It's the market capitalization. more often you will hear market cap, and it's the total amount of outstanding shares times the current share price. So you have Amazon, let's stick with the $100. They have 100 shares totally outstanding, and the price is $100. Those two multiplied gives you the market cap. Okay. Obviously, that's way higher than what I'm listing now, but total outstanding shares times the current price gives you the market cap. And for example, if you look at like, okay, when there's a takeover or an acquisition by a company, market cap is one of the metrics that is looked at, especially if it's about a public company. It's like, okay, well, this is what it's worth right now on the market. There are more metrics, and I'm not going into that right now, such as debt, cash on hand, etc. But market cap is generally a very important metric, and it's one of the first ones that you'll find. Financial ratios we'll go into when I cover the sources. Strategy, marketing, competition, that sort of stuff is really, really important. And the team and the founders, I want to conclude this video with a perspective specifically on that. So knowing when something is under, fairly, or overvalued can help you, of course, decision making as to when to invest. Right? If you are a big fan of a company, but it's like right now, Nvidia is absolutely booming. But there could be metrics along the way that makes you think like, yeah, well, like the juice is out of the stock already. All the metrics seem to be quite high. All the ratios seem to be quite high. Those ratios we'll cover in a second. So, if you have that sort of information and you know how to work with that information, then obviously your decision making will be better. It can help you also when to increase risk and decrease risk. So if you find an asset, this like what we heard before about the asymmetric or sort of like the inefficiencies with assets, that you find an asset that nobody else has discovered yet and is just ridiculously low valued, well, obviously your risk button can be turned a bit. That you say like, okay, well, the team is great, they have a working product, there is usage, they have all the good growth prospects, there's no debt. Then it's like, okay, well, I can take a bet on that. Do you still work with the portfolio example that I gave? Like, I'm going to allocate 5% or something like that. Well, perhaps not, right? If you really know that business or that project or protocol, we'll get to that later, then you can actually turn that risk knob up, right? Well, I would ask, help remind me, but I don't think that's going to be possible in this format. But two things that I want to highlight. So this increase and decreasing risk, but also the team and the founders' perspective. I'll hopefully close with that at the end. And of course, tweak your basket, right? If we're just not talking about buying the S&P or any index, but actually doing this ourselves and managing our portfolio ourselves, the better you understand these businesses, the better you can tweak your portfolio. It's really, really that simple. Okay. Yeah, so that is not it for this video. That was it for the slides, but we have some browser stuff to cover, of course. So Investopedia, again, we're leaning on Investopedia heavily for this, and I'm going to just let you go through the ratios here, and we'll cover it in the lecture. So this video, I'm going to keep it just pointing to what we need to go towards. Just know when it comes to, so again, qualitative, quantitative, etc. It's all there. And then here we have the some of the ratios that you can find already. Just know that any metric, any ratio on its own is never enough to come to a conclusion or come to an investment decision. You always need to take into account multiple ratios, multiple factors. You need to take into account, if you can, the FA, so fundamental analysis, perhaps some technical analysis as well, and what is the general sentiment, the market sentiment. Is it a good time to be an investor? Like first of all, that's a good question to ask, right? All this stuff will help you incorporate a plan, help you create a plan to actually make the decisions. And if that sounds difficult and overwhelming and sounds like a lot, at the beginning it is. This is a lot of new terminology and it's a lot of new language, new products, etc. But if you just step by step take it slow and study this, then it really is not that difficult. It's not rocket science. Of course, the deeper you go, the more stuff you'll find and the more complicated it can get. But with a basic investigation, basic research, you can already go quite far. So just read through this, what these ratios are, and there are always here you see it. Any ratio is too narrowly focused to stand alone. And for example, there are always the PE ratio is something that is super famous. It's been always there on investors, but and there was this metric like, okay, if like a low PE ratio is good, a high PE ratio is not good, and it can lead an investor to think like, okay, I'm not going to invest in a low PE ratio stock, but a high PE ratio stock. But if you look, for example, at Amazon, and here we have a cool tool to do that. Finviz, we'll come back to that plenty. You also find it in the video in the sources. But here, for example, we work with ticker symbols, so an abbreviation of a company's name, that is. And we can type AMZN, so we have Amazon, and then we get a $30,000 price pot. But I just actually want to see what is that? This is full of ads. It's really seriously, and I'm on Brave browser, or am I not? No, I'm actually not on this laptop. So a small tip: Brave browser. If you're not using it yet, you will block most of this stuff, I guess. So the PE ratio over here, 107. Generally, I think the low PE ratio that is sort of desirable is 20, 30, something like that. Amazon has been structurally above that. So just by going by that PE metric, you could say like, well, wow, the PE ratio is 50. I'm not going to invest in that. But actually, there are signals for potential future more and more growth in that high PE ratio number. That could you lead to think, okay, well, but then the high PE ratio number is a signal of potential strength as well, right? That people are really valuing this company to have sustainable, but also significant growth in the future. And that has been true for Amazon, for example. So long story short, not any single metric can stand on its own. And you need to incorporate all these metrics per company, but then also like compare it to competitors in the same sector. Like how does their PE, what does their PE ratio or other ratios look like? Everything will become clear when you read through this slowly, ask questions, ask ChatGPT for questions, right? If something is not clear, it's maybe overwhelming at the beginning, but really take it step by step, try to understand it, and you'll see that it's not that difficult. An example perspective, again, the plain bagel, there they are again, 2 months ago. It's a recent video, it's a cool video, and it's just a perspective again on their approach or his approach, and how to sort of frame this. So I will give you some perspective in the lecture, for example. You get some perspective over here, you get some perspective from, here we have Mr. Warren Buffett. So what does he look at when he looks at a company? And all these perspectives are going to help you form your own perspective, hopefully. One thing that caught my attention here, so Buffett sort of like famously not missed, but he, let's see, where are we? Well, somewhere here. So sorry, but he famously sort of missed the entire tech boom, and it is somewhere in this article. He invests only in what he knows, and at the time, or he didn't understand the valuation of tech well enough, and he sort of like famously missed that, right? So look at nobody's perfect. Everybody sort of misses things all the time, right? We can just simply do our best and try to spot the value where we can find it. But just read about this and what his particular style is, the metrics that he looks at, So if you look at, for example, all the like data from tech companies, that's very different data because they see such tremendous growth in short period of time. Like I don't know, Snapchat or Facebook or all those companies, the metrics are different, right? So it's different than investing in a railway company that does it takes 40 years to build their business instead of Instagram that took 5 and took over the world. Right, so that's just something to consider and some perspective. Beyond Meat, interesting video. I mentioned this before. This company, I found this really interesting video because I've tried the product before. I have nothing against it. I think it's a good direction to go towards if we want sort of like sustainable food for the entire planet in the coming centuries. And this is something that, for example, that's something I'm monitoring. It's like, okay, we have these metrics of a growing population. People say, we're getting sort of overpopulated. Whether that's true, I don't care. I'm not really necessarily concerned with that. But you will see initiatives that try to, battle climate change, try to change our eating habits, etc. And somewhere, someday, there probably will be a company that's going to do this successfully. And the story of Beyond Meat, they may have been early. They made a couple of mistakes, I guess, in their strategy, as you can see in the video. They had huge celebrity endorsements. Kim Kardashian, I think, was one. I think either Brad Pitt or Jim Carrey, I forget. Or perhaps it was someone else. Like a famous a person invested, or Leonardo DiCaprio, that was it. Invested in this company as well. And so like quite a lot of traction. Like they were, the product, well, you can find it in Albert Heijn, but you can also find it in Walmart in the US. But the stock, as you can see, went from $186 to $13.32, and it's still bleeding right now as I record this. So, but interesting to see how, a company that has a lot of traction in the public still can have an atrocious performance when it comes to the stock. And yeah, again, it's a video that helps you think about this stuff. The advanced source, again, I would encourage everyone to read it. It's not that advanced. It just goes in a little bit deeper as to how to think about evaluating a company. And in this case, including also the SWOT analysis, for example. So strengths, weaknesses, opportunities, and threats, where you just completely dissect a company. That's what Warren Buffett does. He goes through the annual reports, quarterly reports, etc. And he probably, the companies that he's invested in, he will know every metric of that company, right? And that's, for example, one thing that if you, like, I'm not involved that much into this. I know how it works, but I'm not actually invested in stocks right now. And I'm not doing a whole lot of annual report reading. Now, if you want to, for example, what I've talked about when you want to develop an edge, if you do this work, and for example, Chris, our student assistant, he knows about this stuff better and more than I do. And when we are participating on this front, he has an edge over me simply because he took the time to study this, right? He will probably perform better when it comes to fundamental analysis on stocks right now than I do. Well, let's see. I mean, we can place a bet maybe, but no, let's not do that. But you get my point. The better you understand this, the more you study, the better your performance ultimately is going to be. And that's basically the short of it. Coming back, before I round up with some perspective to market cap, we have two websites, companiesmarketcap.com. Here you can see that Apple currently is the biggest company in the world. Market cap $2.83 $1 trillion, right? So here you can sort of like value the company. So one cool way to look at this, for example, is if you have, let's say Nvidia has been growing really quite much. Let's say that they have a competing company somewhere which, is worth a tenth of that. There is asymmetry there potentially, right? It could suggest that either Nvidia is overvalued or the other one is undervalued. And you can, if you have your sector or your subsector in front of you and you know the companies that operate in there, you can start to look for asymmetry, right? Same goes for Tesla. When you would value this as a car company just like a few years ago, and then compare that to General Motors, etc., or just like car brands on their own, you would have seen that with the potentiality into the future, that was really quite undervalued. I'm not saying that it still is. I don't know. I haven't done that research, to be honest. But that is one way to go about this. The same for crypto, but we'll come back to that. That is CoinMarketCap. So again, works the same, cryptocurrencies. In this case, the total circulating coins times the current price is the market cap. Okay. Right. Let me just quickly go to PowerPoint. Bear with me as I do this. I wanted to give you a perspective on what was it? The team and the founders. Yeah, I think that's probably the most important piece of perspective that I can give. So what I've noticed in my journey, and also not only personal journey, but in the research that I've done when it comes to like, okay, how can you pick these stocks or pick these companies or find these companies that start obviously small, like I think everything starts with an idea over here. And when that comes to fruition, like how can you recognize and how can you spot these early opportunities? And the one thing that for me has always been the leader at which I'm sort of like comfortable to take a lot of risk or not comfortable to take any risk at all has been founders or team members, and especially when it comes to founders. Why is that? Because if you have a founder that works with, that you can recognize that they have vision, they have, integrity, they have like all sort of like good human qualities not arrogance, like humility. I don't know if I said already, but when you find somebody, like obviously intelligence and business savvy, etc., when you find these people that work with a vision, you have somebody that tends to think on a long term and is not necessarily focused on short-term gains or the money or etc. And just to give a couple of examples, like Richard Branson is one, a billionaire who has that philosophy. If you read some of his books as well, he says that specifically. It's like business is about identifying an opportunity or solving a problem somewhere that people have, or that people that don't even know that they have that yet, and working towards solving that problem. The money will always come after. And that is also true for investing. Like if you take this game much more to, in a sense where like, okay, there are companies out there or people, founders, etc., and I want to support them financially in order to realize this vision that they have. You may fail left and right? Because of not every founder is going to be the next Elon Musk, for example. But when you do find these people, when you recognize their vision and their determination, you generally have a potential for like a very solid investment. For me, for example, that was Vitalik Buterin of Ethereum. When I started to read about him and listen to him in 2016, I was like, whoa, this guy is on another level. He is extremely intelligent, probably one of the most intelligent people I've ever seen. He is humble, he is childlike, he has humor, he doesn't take things too serious, but he has a very clear vision and is a very determined person. Elon Musk is probably the same with this deterministic vision, right? Steve Jobs, just name them, Jeff Bezos, etc. It takes maybe some time and skill to start to recognize that talent, but the difference between investing in companies that are run by these people and the companies that are run by people that are either looking for a quick cash grab or are only caring about their investors, or early stage investors try to get as much money as possible in the beginning, and then this happens in crypto a lot, for example, and that's a huge red flag. Red flag is when something you need to avoid. And I'll round up, but I think that is an important perspective, because those investments generally, at least in my experience, there you can actually apply this Druckenmiller method, where you said like, yeah, you know what, Elon Musk, he has this vision. I may or may not agree with everything he does, but he is like a very clear thought leader and a visionary. And this goes for many business people out there. Cathie Wood is one, for example, as well. I wouldn't also bet against her. And yes, it will take time for them to realize what they envision, but that is what investing is about. It does take time. Warren Buffett said, like, the stock market is a device for transferring money from the impatient to the patient. And that is something we don't really find nowadays. Like, we want a quick meme coin that goes up 3x, etc. But you will see that in the coming years, I think we will revert back to finding actual value for the coming future. And so, yeah, to round up, that is one of the perspectives that I can give you. Look for solid leadership. Some people that actually work at a problem or at a business with their hearts fully in it, right? Regardless of whatever, that business needs to succeed. And that is something that you can build on for the longer term. So that's just one perspective. I'll give you more perspectives, but let's round up this video. We're under 25 minutes. I think that's enough for now. Again, it's just get out there, get in there, do your thing, do your research. Really, always do your own research. The more you are able to do your own research, the more you're able to build your own thesis and your own conviction into something. And as I said, like, not your what did I say? Not your thesis, not your conviction. That is something that I want to get back at. I'm not going to do that for now. That's going to be a different rant. See you in the next video.